This is WCNY's The Capitol Press Room, and we're talking about new rules issued by the State Department of Financial Services designed to regulate the evolving buy now, pay later industry. And our guest is Winston Berkman-Breen, legal director for Protect Borrowers, who previously, in another life, worked at the State Department of Financial Services. We'll begin our conversation by comparing the buy now, pay later industry and the fees and interests incorporated with that compared to the process of buying something on layaway of yesteryears.
Well, the difference is the third party. So this is not necessarily an installment plan to the seller, the merchant, where, after 18 months you own the sofa or something along those lines, or Sears and, a refrigerator. Here, the merchant store is getting paid full at the point of transaction, and then you owe a third party your subsequent installments. And again, from a consumer, that might feel empowering or allow you to buy things that were previously unacceptable, or unfortunately sometimes send you on a buying spree, and maybe you are buying more than you can actually afford. So that's where the consumer protection front gets in. There are a couple technical consumer protection concerns. First of all, are these loans? When the industry came around, it went out of its way to say, we're not loans, we don't charge interest. And the way they structured their product, this sort of 4 installments or fewer, 0 interest, had the effect of evading some federal consumer protection laws, or the attempt of evading that carved out sort of those shorter term installment loan products from their coverage. And so right out of the gates, there was questions about this industry. How should it be regulated? Does it have to comply with New York State's lending laws? We have what's called a licensed lender law here under the banking law. You have to come get a license if you're doing certain activity in the state. Are they doing that activity? Does the fact that they say they don't charge interest mean that it's not a loan? Then there's even the question of interest. They might say there's 0 interest, but when you look into the details and the profit margins, they are really charging high late fees and lots of late fees. It's definitely a feature, not a bug of the product. So then you have to ask, okay, if this is part of the business model, is this a form of interest by way of finance charge? Are you effectively saying you don't have to pay us interest, but we know you're going to end up paying us $15 for a missed payment, so that becomes the cost of this product? So these were a lot of open-ended questions, right? We saw a lot of big companies like Klarna or Affirm or Afterpay entering this space, and initially it was taking off with consumers, but the consumer protection regulatory community didn't really catch up in the initial days and sort of say definitively, these are loans, come get licensed, or these aren't loans, you don't have to get licensed.
And with more players getting into this space, have we also seen a change in terms of where it's being applied? Is it not just for those traditional online goods and services that someone might purchase? Are we seeing it in other aspects of life as well?
Yeah, so the story of buy now, pay later is very interesting. Initially, again, it was very sort of merchant retailer point of sale. Whether that was online or in person. I think we're all probably familiar with the online checkout cart, and you can, pay with a credit card, pay with, whatever form, or click a button after pay Affirm. Then we started to see it in some more problematic areas. For instance, we saw sort of online tech boot camp companies, sort of shady for-profit schools offering sort of PayPal for and pay, or other companies. And whether or not these buy now, pay later companies knew what they were financing, that they were getting in bed with bad actors, is not really the point. The point is bad actors started to use this as a way to bring more people in the door, sell them high-cost, low-quality services, basically, bad online for-profit schools, as an example. So that was sort of the use by bad actors of this existing product. And then we saw, not nefariously, but maybe concerningly, it enter everyday life. I mean, I think probably listeners can remember a year or two ago, we started to see news articles about people using buy now, pay later for their burrito, right? We're financing our $11 burrito, or depending on where you live, $6 or $20. Still, should we be financing over 4 installment payments our lunch, right? So that's a question of, has it creeped into our day-to-day? And then the latest, which has really just emerged in the last few weeks, and my organization put out a report on, is people using buy now, pay later for their rent, taking their monthly rent, and instead of paying it 1 installment in the first 5 days of the month, financing out over multiple installments through these companies over 2, 4, 6, or 8 weeks.
Well, let's talk about the legislative response then. What sort of guardrails does the 2025 Buy Now, Pay Later law put in place, and what sort of rules of the road are being left to be answered by the Department of Financial Services with regulations?
So what the 2025 law does essentially is say that the buy now, pay later industry, this sort of pay an installment for a specific product or service that you're getting. It's not a credit card or that's a general open line of credit, and it's not a general consumer loan where you get the money, then you go spend it. It's a third party installment payment plan or loan for a specific product and service that you're buying. It says if you're going to be in that industry, you have to get a license. And in that way, it sort of sidesteps the question about whether that was already licensable activity in New York. The question of whether you already needed a licensed lender license to do buy now, pay later is sort of moot, because you definitely have to get a buy now, pay later license. With licensure comes a lot of oversight by the state. So, the law and the subsequent regulations go into great detail about the mechanics of licensure, all the books and records they have to share with the state, what their annual or ongoing obligations are to report to the state. But then there's a whole bunch of sort of consumer protections, both sort of in the flavor of guardrails, like if you are going to engage in buy now, pay later lending, here are the disclosures you have to provide someone. Here are the monthly or periodic account statements you have to send. Here's how you have to handle consumer complaints. They really tell this industry, for you to operate not just lawfully, but appropriately, here's what we expect of you. And then there's also a sort of grab bag of don't engage in harmful or fraudulent or unfair abusive conduct that we like to see with any financial regulatory law, is the rules of the road and also what we might call prohibitive conduct. So it's a pretty comprehensive bill, and the regs that have come out subsequently, recently, add some flesh to that and some more operative details.
Yeah, and sticking with the details, I'm looking at a restriction on interest rates capped at 16%. Penalty fees would be capped at basically $8. It addresses a prohibition on convenience fees, and there's an issue with prepayment fees as well. Do you think those efforts go far enough, or could we have even more stringent rules that you think maybe wouldn't deter this industry from operating in New York and being available?
I don't think they go too far, certainly. Okay. I think that those are reasonable and necessary regulations and guardrails to make sure that as this industry continues to operate, because it's already here, and so this is sort of informed by the lived experience of users in the market over the last few years, to make sure this works. They touch on a lot of the core areas, as you said, sort of penalties and how much they can charge. They also go into great detail about data privacy, which is a really important aspect increasingly in our sort of very online world, and making sure that any use by the buy now, pay later companies of our data, any of our data, is only with consent, and that consent can be revoked, right? So that they can't just take our data and then sell it or use it for purposes that we didn't know about or wouldn't have agreed to. So that the data privacy is a growing problem in the country and was addressed, I think, pretty well in these proposed regulations. There are some areas where I think there needs to be a little more clarity. This question of, what is interest? You said that they, have a cap of 16% interest, which is the state civil usury cap here in New York, isn't so simple as, well, how much are you going to charge me? What percent APR is a phrase people might have heard, annual percentage rate, for the cost of borrowing this money or making these installment payments. There are all sorts of ways that we're seeing the current buy now, pay later industry successfully and unsuccessfully seek to avoid calculating certain fees as interest. For instance, you might have a company that, in addition to the cost of any specific installment loan that they give you, might charge a sort of monthly or annually nominal membership fee, right? So now you have access to the buy now, pay later platform, and you can get individual loans as needed. Should that membership fee be calculated in as part of the interest rate? It is part of the overall cost of credit, but it's different than the interest in terms of what interest is charged on any individual loan you might have. So I do think that there is some additional detail that can be provided. These are just proposed regulations. They're going to be open for comment over the next few weeks, and then DFS will intake all that information. Similarly, there has to be, and the law requires this, risk-based underwriting, which is to say they have to make sure you can afford to take on these loans. Some of these are zero interest loans and truly zero interest, but some, you have to make sure it can actually be paid back with or without interest.
And how do they assess something like that?
That's the thing.
Especially in that case of that $6 burrito, because I think anyone should be able to eventually pay that back.
Right. So that's the question. What does that mean? Does that mean a soft pull on your credit report? Does that mean that you have to be aware of and check to see how many other outstanding buy now, pay later obligations a consumer has? This is one of the big risks when buy now, pay later first arrived, is that people would get stuck with what's called stacking, where they take out so many at once because they only need to pay a quarter of any one of them up front. But then suddenly they realize that they have 7 quarterly payments due all on the same day 2 weeks later, and they don't actually have enough money to cover that. And part of that reason is these companies, if you can take out one loan from any of the other companies, they don't necessarily know that you've taken out a loan from one of their competitors, right? So they don't know that in 2 weeks you're going to have 1 or 6 other installments due. So really getting at what DFS's expectation is for this risk-based underwriting is going to be important for these regulations to be successful.
Well, given the ambiguity you just flagged and the fact that with anything in real life, if people are looking to make money, they're going to get creative. How important is it that when these regulations are in effect, that the Department of Financial Services is actively enforcing them and is actively, I guess, walking the beat, so to speak?
Oh, it's really critical, and this is true of any of the licensing regimes that they put into place. I mean, you and I have talked before about they are now empowered to go after folks who should be licensed but aren't licensed. Sure. But in terms of those who they do license, they need to stay on top of them, and that is, should happen somewhat automatically through the law and regulations annual reporting requirements. The regulations and the law require that if the buy now pay later company changes its model a little bit, they have to affirmatively tell the superintendent of the Department of Financial Services and get permission. So there are some built-in touch points, but it will be important that DFS takes that data that they're being given and then looks at it, right? They can't just put it in a drawer somewhere and say, check that off the list, this company complied. They have to look and see how things are going. The law is very prescriptive, but they still have room in their regulations to revise, right? So they can sort of check in on things in a couple of years based on how things have been going. And within certain parameters, they can make revisions if necessary, or go back to the legislature and ask for a bigger change if that's needed too.
Well, is this the end of the issues as it pertains to financial activities in New York that, for lack of a better expression, walk like a loan, look like a loan, quack like a loan, but are not regulated like a loan? Or is there additional activities that state lawmakers need to identify and give state financial regulators the tools to address?
It's certainly not the end of companies that are going to try not to be regulated or want to avoid the cost of doing business and sort of maximize their profits at the expense of New Yorkers and in violation of New York law. A major industry out there across the country, and certainly trying to gain favor here in Albany, is the Earned Wage Access, or EWA, folks who purport to give you your paycheck sooner. We might get paid on a weekly or biweekly cycle, and they say, oh, well, you've earned the money before then, we'll get it to you before then, and then on your payday, we'll just take that out of your bank account. That's just an online payday loan, right? That's what payday loans are. You give a check to the payday loan company, post-date it, and then on the day that your paycheck hits, they cash that check and everyone's good to go. Nationwide, we're seeing EWA companies go around and ask for special licensure or to be excluded from existing licensure because they're somehow not a loan. They do this for free. They, whatever the justification might be. And I know that they're here in New York asking for the same. So that's just a current example of companies going around acting as if they are not a duck, despite the fact that they're quacking, right? And I can imagine in 5 years, we'll see a couple more. There's no lack of inventiveness in terms of both the sort of fintech industry, but also, which is not entirely crooks, I don't want to suggest that, but in terms of actual crooks, there's also no lack of imagination and inventiveness.
Well, we've been speaking with Winston Berkman-Breen. He's the legal director for Protect Borrowers. Winston, thank you so much for making the time. I really appreciate it.
Yeah, thanks for having me.
Thanks for listening to today's edition of the Capitol Press Room. For an insider take on what's happening in state government, check out our Dispatches from Planet Albany show, available wherever you get podcasts or at capitolpressroom.org.
Join us again for Capitol Press Room, a production of WCNY Connected, Syracuse.